Well, let's get started. Welcome everybody for joining us today. My name is Brad Sanders. I'm with CBRE. I lead CBRE's retail project management business in the United States. We focus on the design and construction of stores as well as shopping centers throughout the Americas. Most importantly, I'm a member of the RCA Advisory Board, and I want to welcome you to the very first RCA and RCA Advisory Board quarterly WebEx conversation. The goal here is to provide some industry insight to our RCA members to help them with their business. It could be on topics regarding trends in retail, trends in construction, and topics that are focused on simply running the business of a retail contractor. So we're excited to kick off this new series. Today we'll call it Volume 1, Episode 1 of our series. The format for the conversation today, we'll have a great speaker, Melina Cordero, and then we'll have a little bit of questions and conversation at the end. Let me give a quick introduction and an overview of Melina's background. Melina works at CBRE, and in her 4-year tenure at CBRE, she's had some pretty important positions. Previously, she was the global head of retail research, and recently was promoted to move into the role of Managing Director of Retail Capital Markets. Melina's background, she has an undergraduate degree in French from Yale, très bien, and she has a master's in urban and economic development from the London School of Economics, and in collaboration with the Institute of Political Science in Paris. She also has a master's in economic development and international development from London School of Economics. Melina is very active, traveling around the country, speaking to the boards of publicly held companies regarding research and trends in real estate. And it's a pleasure to welcome her here today for, again, Volume 1, Episode 1 of our quarterly RCA speaker series. So Melina, thanks for joining, and we'll turn it over to you.
Well, thanks, Brad, and thanks to the group, and I'm honored to be a part of the inaugural presentation of this speaker session, so thank you for having me. So what I'll do today, coming from my retail background and what I'm dealing with day to day, is I thought I would bring you a sort of beyond the headlines story about what's happening in retail. As all of you will know well, retail has seen a ton of changes over the past couple of years. We'll continue to see changes. But it's also seen a lot of negative headlines around those changes. And in my role in research and in my current role with investment sales, I spent a lot of time debunking a lot of myths around what is and what isn't happening in retail. So what I thought I'd walk the group through today is the best hits highlights version of what I see. Now this presentation, this content is something that I take around to clients both on the retailer side and the ownership side, where I spend a lot of time. And hopefully we'll cover a lot of the areas that will be relevant to you, and I'm always open to questions and follow-up. So if there's anything I don't hit on, you're more than welcome to follow up with those questions. But to kick it off, what I always like to start with is what we can't avoid, which is the headlines, right? And so when you look at what's written in the newspapers and on Twitter and on TV, we're getting a lot of stories like this. Retail's dead, it's an apocalypse, there's a meltdown, the economy's failing, Twitter has a lot of opinions about it. So the idea here that we all sort of assume is correct is that retail is dead, it's being replaced by online, and there's really not much of a future to brick and mortar, right? However, a lot of that is greatly exaggerated and to the detriment of a lot of the opportunity that we see in retail and that a lot of our clients are seeing. So what I'll do is walk through what we're really seeing on the ground, reality versus myth, in 3 parts. So one is what's going on with the consumer, 2 is what's happening with retailers and retailing. And then third, what impact is that having on physical real estate? So we'll weave that through the conversation. So if we start with the consumer, the predominant myth around us as consumers is that we're not spending, right? This is what most people assume and the headlines suggest. However, it's just not true. When we look at the data points around this and we look at consumer sentiment on one hand, which you see here on the left, and then retail sales growth, which you see on the right, it really is not telling that story. Consumer sentiment has been at a 17-18-year high, which means that consumers are confident in the economy and, more importantly, in their own financial health and future for the next couple of quarters, which usually bodes well for retail sales, and in this case it does. So on the right, when you look at year-on-year growth in retail sales, that's actually been quite strong, and 2018 was much higher than even anticipated. What's interesting is the headlines started to get a little negative on talking about sluggish retail sales growth right around 2014, 2015, when you can see that dip in the chart on the right, where it drops to about 2.5 or 3%. Interestingly, that drop there was not really due to a decline in retail sales, traditional retail sales. It was due to the decline in gas prices. Because oil and gas station sales are included in retail sales reporting from the Census Bureau, it impacted negatively the volumes of retail sales we were seeing. But that had nothing to do with things like shoes, jewelry, health and beauty. This was triggered primarily by gas station sales. So that's just a little anecdote to say, you know, when you're looking at these top line figures and the headlines especially, you need to be really careful and really aware of what is and isn't included. Because overall the point here is that retail sales growth has actually been strong. So the question then becomes, if retail sales growth is fine, why is there so much concern? My thesis on this is that the issue is not that we aren't spending, it's that we're spending differently. And because we're spending differently, it's catching a lot of the industry by surprise, and we're missing where the growth is. So first and foremost, which categories are receiving growth has changed pretty significantly. If you look at this slide, on the left I have over the past 5 years the high growth categories, and on the right the lower growth categories. So in low growth, you have things like office supplies, department stores, bookstores, clothing. In the high growth categories, you have a lot of food and beverage, health and beauty, furniture has been really strong, jewelry. So what's interesting is that most of our malls and a lot of our shopping center categories tend to be concentrated in the low growth categories. And a lot of the fast growing retailers and tenants that are absorbing space tend to be in the high growth categories. The challenge is that the industry is still, in my opinion, very much used to looking at the categories on the right as a barometer of what's happening in retail, when what's really happening is growth on the left, and we're missing some of that. So there's a lot of growth in corners and areas of the industry that we're not paying as much attention to. But I think that's changing. We've definitely seen a lot of conversation about the growth of food and beverage and furniture of late. But this is one point here. And the other way that we as consumers have shifted in our spending is in what I call the barbell effect. Now, the barbell effect essentially says that since 2008, 2009, what we've done is the consumer base has really trended towards either end of the pricing spectrum. And that means that we're going and spending at Ross and TJX and Five Below and Ulta Beauty, and or we're going and spending higher up at some of the luxury or higher end brands. And what's happened is we fled the mid-range. So a perfect example of that is today, most of us, if we want to buy a white t-shirt, we're not going to go and spend $20 at the Gap or Abercrombie & Fitch. We're going to go spend $10 at one of the stores in the discount or off-price section, or we're going to go up market and spend on a brand we really like or a brand we really feel close to. So what that's done is created a lot of pressure on the mid-range, mid-priced retailers. And if you look at this timeline here, which I stole from the internet, but which I think is a fascinating visual, you can see from about January 15 to March of last year, this is just a sampling of a lot of the retailers and brands that have either declared bankruptcy or closed significant portions of their store base. And if you look at these brands, most of them are right in those low growth, soft goods categories, and a lot of them are in that mid-price range, almost all of them. A lot of them are also backed by private equity, which is another argument about what's been fragile around these retailers and their financial or operating structures. But for the purpose of this conversation, it's important to note that they're in the mid-price and soft goods ranges, right? And so a lot of the growth has been on either end of the spectrum. The other major myth around consumers, and one of my favorite ones to talk about since I fall into this category, is this idea that millennials are ruining everything, right? And retail is just one among many things, from kale and the Olympics to cereal and movies, that we're just absolutely ruining. And the idea here is a fear that demographic changes are going to negatively impact brick and mortar retail. However, I like to introduce Millennial Ben into the conversation, and in many ways, Millennial Ben is my favorite millennial stock photo, and he represents everything we sort of hate about the millennial, right? It's the middle of the day, he's not at work, he's eating, his overpriced pulled pork sandwich, he is definitely not married, he definitely doesn't own any assets, he probably has a lot of debt, and he's not contributing to the economy, and he's certainly not contributing to retail. However, when you dive into what he's actually doing in this photo, he's spending quite a bit, right? So that overpriced pulled pork sandwich, the iced oat milk latte, the hair and beauty grooming that he probably does on a very regular basis, the tattoos are a lot of money going to retail, and then the t-shirt, which is either $7 or $70, right? So the interesting thing about this story, or this Ben, is we have a lot of assumptions around how millennials spend or how they live, and actually Ben here is spending quite a lot, but in those categories that we talked about, which are the new growth categories, as opposed to things like the t-shirt, where he's not spending that much, which is an older growth category and which is not growing quite as much today. And here are a couple other sort of myth-busting points I like to talk about with the millennial. The millennial does believe in marriage and mortgage, but is just doing it on a delayed time scale. A lot of that is due to the rise of student debt, but also the timing of the recession, which really impeded the career growth for a lot of millennials early on. So they're going to do everything our parents did from a life stage standpoint, just a couple years behind. For the millennial, convenience is really important, and digital engagement and experience, which we'll talk about in a little bit. So
Melina, where does Millennial Ben shop? Is he go to a shopping center? Is he living in Manhattan? Where does he shop?
That's a great question. So in this, Ben in this case probably lives downtown, right? He lives in a city. He shops a mix of online, but then also really is willing to spend on brands that he cares about, probably really likes an experience, and I would say is spending the bulk of his retail dollars on everything you're seeing in the photo. He probably eats out several times a week, if not daily. The health and beauty category has been a big push from millennials. Interestingly, have I think the growth of male health and beauty grooming and the sort of destigmatization of that has really driven growth in that category. So he's spending on the categories you see in the photo. He's living downtown, but in a couple of years is probably going to move to the suburbs for the same reason his parents did. And actually, statistically speaking, millennial migration is towards the suburbs right now because they're approaching the age of settling down, having a family, purchasing houses, and it's still more affordable in the suburbs than it is downtown.
That's an important point. I want to come back to that at the end, talking about that migration.
Absolutely. And it's not just millennials, by the way. All populations are trending towards the suburbs. So we can talk about that. So moving on to retailers and retailing, right? What does all of this consumer shifting mean for retailers and the retailers that a lot of you are probably doing work for? And the predominant myth with retailing is that it's what I call the e-apocalypse, which is that e-commerce is taking over brick and mortar. Consumers are never going to go in the store, even though Ben, as I showed you, was in a retail space in that photo. And that pretty soon all we'll have left is a world and a landscape of empty strip centers and no one going to stores, right? It's not good for any of us. And when you look at the data headlines, everything we see tends to support this idea, this trend, right? So if you look at e-commerce as a percentage of total retail sales year by year, right now we're at about 10.5% of all retail sales are happening in the store. But you can see how quickly that rose from 2.5% in 2005. It's going to continue to rise. And what's even scarier than this chart is this second chart here, which shows you in the top line in pink, the year-on-year growth in e-commerce sales, and in the bottom line in green, the year-on-year growth in in-store retail sales. Now, the point here is that online retail sales have been growing at about 15% a year since 2010. The same for in-store sales is about 4%. So this is what's terrifying for the industry, is this idea that e-commerce is eventually going to replace brick and mortar because look how much faster it's growing, right? However, I challenge the assumptions around this data because if you take the exact same numbers and you present them in a slightly different way, you have a very different picture of what's going on. So in this chart, again, these are the exact same figures from the previous slide, just presented differently. So in the dark green, the bulk of this chart is the total amount of in-store retail sales, and that little sliver on the bottom, which you can probably barely even see, is online sales. So we're just flipping the way that we present this data, and it tells such a different story. And the main point here is that about 90%, right, just under 90% of all retail sales are happening in the store. What's another really interesting point that most headlines don't capture is that the online sales that we're talking about in those e-commerce figures, it's not all online-only retailers. And actually, over 50% of these online e-commerce sales are actually the online sales of brick-and-mortar brands, right? So Nordstrom.com, Macy's.com, Gap.com, all that is calculated as e-commerce sales, but they're going to brick-and-mortar brands. So the growth of online does not necessarily mean the death of brick-and-mortar brands. It means a shifting of where those sales are taking place, right? And if you calculate all that out, it means that less than 4 or 5% of all retail sales happening in the U.S. today are coming from online-only retailers, right? So this idea.
So let me ask this question: If I buy something online and have it delivered to the store, is that sales figure captured as online retail or in-store retail?
That's such a good question, and it's so hard to answer because every retailer does it differently, and there's no general standard or rule around how retailers capture this. Now, in that example that you gave of buying something online and picking up in the store, some retailers will count it as an online. They'll count, where did the purchase point happen? Some will count it as an in-store because it involves a point of contact with the store. Now, the important little tricky bit to keep in mind is it's in the interest of retailers in a lot of cases not to report that as an in-store sale. Because if you're in a mall or in a lot of shopping centers, you're reporting your in-store sales to your landlord. So for a lot of retailers, there's a bit of an incentive to not report those sales, to show lower sales volumes, to be able to leverage negotiations like requesting rent relief or lowering future rent increases. So there's a bit of a challenge here for landlords around transparency into what's happening. And retailers are playing a little bit of an accounting game here because they can. So there's no easy answer to that one, and retailers are also doing it differently at the moment. And to that point, I think it's a great question to lead into this slide, which is talking about how brick and mortar brands are leveraging e-commerce. A lot of them are having to invest really heavily in their online channels. So if you look at a brand like Nordstrom, people are always shocked to find out that over 30% of Nordstrom sales are coming from their online channel. If you look at a brand like Urban Outfitters, it's even higher at around 40%. And then Williams-Sonoma actually generates about 55%, so more than half of its sales are coming from its online channel. These numbers are a lot higher than a lot of people assume, but it's because these retailers are investing heavily in their online channels, partly because they have to. They can't afford to lose the consumer they have online. They're trying hard to get them back into the store because they gather more profit that way. But something to be aware of is a major challenge for retailers as they're shifting their revenue structures. Now the question then becomes for a retailer, if you're generating 50% of your revenue or more in a store, online, why wouldn't you just close 50% of your stores, right? You don't need them. The answer, however, is a little complicated because it's not that simple. First and foremost, e-commerce is extraordinarily expensive. I think there's a myth in the sector that doing everything online is more efficient and cost-effective and cheaper because you don't have all the retail real estate to deal with. And that's simply false because there are incredible costs associated with logistics, delivery, and returns. that retailers and especially traditional retailers, brick and mortar retailers, supply chains are not built for this. Retailer supply chains were built to distribute to stores on a regular basis. And so the classic model would be if you have 500 stores across the country, you'd have one major distribution center somewhere central in the Midwest from which you would distribute to your portfolio of stores every month or on a regular basis. And now that model blows up when you need to be doing that plus delivering to millions of doorsteps daily and increasingly hourly. And by the way, you have to do it for free. So this has generated a ton of cost increase for retailers and a lot of margin pressure because there's not necessarily a lot more profit coming through if we're not paying for shipping. The other thing we're not paying for in most cases is returns, and this is probably the biggest challenge that retailers face today because when we buy something in the store, not online, we return about 8% of the time. And when we buy something online, we return anywhere between 20 and 40% of the time, depending on the retailer, depending on the time of year. And retail supply chains, as I described before, were not built to go the other way. So this idea of what the industry calls reverse logistics has been a big, big challenge for retailers. And this, I would argue, is the main factor driving the profit margin pressures that retailers have faced and a lot of the cost pressures they're seeing. At the same time, retailers have realized that stores actually generate a pretty decent profit. So the spend per transaction in stores tends to be higher, meaning if we go and buy a pair of shoes online, we'll find the shoes, we'll click buy, we'll close the browser, and we move on with our day. When we buy the shoes in the store, we'll end up with those shoes plus a pair of socks plus a lollipop and a candy bar, right? It's human nature and psychology. We end up with more than we meant to walk out with. So retailers are realizing that the upsell on consumers is better in a store than it is online, right? And they're finding that stores help drive online sales. So Macy's very famously came out a year or two ago, as other retailers have since, and said, look, when we close a store, we experience drops in our online sales as much as 20%. So what retailers are learning is that even if transactions are happening online, they are driven in large part by experiences that we are having in the store. We may be browsing in the store, trying things on, looking for inspiration. So transactions as they shift online does not necessarily diminish the importance of the store. And so that's why we're seeing this trend of what everyone calls clicks to bricks, which is these online-only players that are opening stores now. And some of them claimed that they would never open a store. That wasn't their business model, and most of them have. And we really think that online-only retail, there's a limit to how much these players can do when they stay online. So something like a Warby Parker was not generating profit as a company until it started opening stores. So it's a really compelling story as to why brick and mortar is pretty critical to these players, right? At the same time, what's fundamentally changed is the purpose of the store, and this is where I think all of your roles comes in, and where you're going to see your industry impacted pretty significantly, because it's not that e-commerce is taking over brick and mortar. It could be the other way around, and brick and mortar brands are trying hard to figure out a way to keep the consumer coming into the store and keep the brick and mortar relevant because it's so critical to their profit margins. So the role of the store has changed for retailers from a space of transactions, which you can see on the left, to something else. And when retailers were trying to have a space of transactions, it was about fitting as much stuff and merchandise in the store as possible and generating as much traffic in there as possible. And it was about having as many stores as you could to generate revenue without cannibalizing. But on the right, what you have today is retail as showroom, not for all categories and brands, but as an example, retail as showroom, as experience, as lounge space, right, as brand building. And the question is, how do you measure that? How do you go from measuring a space of transactions to whatever it is now? And how do you design these stores? And that's what retailers are all trying to figure out. And I think one of the best examples of how this world is changing is this right here, which if we were live and in a room, I would make you try and guess what this is. This is the Capital One Cafe concept. And what Capital One is doing is investing really heavily on this fleet of large format, well-located urban quote-unquote banks that really look like hangout spaces that have a coffee shop inside where you can come in, have free Wi-Fi. You may not even make a transaction or ask for a service. You may not even be a Capital One member, but this space is designed to sort of build brand loyalty, build brand awareness, and do it in a physical setting. And it's funny, we have one of these Capital One Cafe concepts around the corner from our office here in DC, and I passed it on my way in, and it was jam-packed. So this is what retailers are thinking about and thinking outside the box in terms of what they do with their space. And the question again, though, is how do you measure the success of that? And that is what they're all thinking about and looking into. And the other thing you'll see retailers doing is a diversification of store formats, which I think is really important for your industry to be aware of. If you take something like Target, they've done a great job of this. So Target used to be a one-size-fits-all suburban big box retailer. And now they're realizing they need to be agile. They need to fit into different markets with different merchandise and different store formats. So now they have a campus format. They have urban city Target formats that are smaller. They're playing with pop-ups and mobile retail. Grocers are pretty famous for doing this as well in terms of having their big box stores, maybe their concept stores, or buying chains that allow them to diversify the types of locations they have. But retailers are trying to use their store formats to be agile, fit into different markets, but then attract different kinds of consumers. And that's going to be really important for a lot of brands moving forward, especially the big ones. So for retailers to keep in mind the sort of psychology of the changes they're going through is they're trying to figure out new performance measurements as the industry changes. To Brad, to your question, how do I measure online versus in-store? How do I know how much or how important my brick and mortar chains are versus my online channel so that I know where to put my investment? They're all trying to figure that out, and you'll see a lot of experimentation in store formats and store designs because of that. 2, new and rising costs, right? So construction costs are going up. The cost of logistics for e-commerce are going up. So they're looking for creative ways to reduce costs, and a lot of that will come through automation, both in the store and in the supply chains. So you'll see a lot of that trend in both. And then finally, go ahead, Brad.
Would it be fair to say, so there's all the negative headlines, there's what you're describing as a period of transition, going from what retail used to be, its location, its primary categories, to where you're saying it's going. In this transition period of what the retailers are trying to figure out and how to use their store fleets and how to design, what inning are we in? Do you think we're in this transition period in the 2nd inning, in the 9th inning? When does the new normal get recognized by the consumer?
So that's a great question. And, you know, I could say I think we're in inning 3 or 4, but that almost doesn't matter because I think we're in a new game, right? I think we're in a game that's going to be constantly evolving. So we've always known that retail is an evolving business. It's cyclical in a lot of ways, and you know, someone said once, it's not if a retailer fails, but when. And so this idea that retailers are always cycling in and out, consumer bases are changing, demographics are evolving. But I think that the change and the pace of change we're seeing in the industry because of technology, because of demographics, is much faster than it was before. And so I think the trick for retailers and everybody in the industry is trying to build businesses and models that are agile. So they're built for change, as opposed to saying, okay, this is what I think the future is going to be, therefore I'm going to build and design my store fleet to match. What they're realizing is they can do that today, but maybe irrelevant in 2 or 3 years. So that feeds well into that last point on this slide, which is retailers are trying to build with flexibility, and that's everything from the walls in a store to the location to the model, right? So they're asking for shorter-term leases. They're asking for fit-outs that allow them to change that. We're seeing this in the office space as well, a lot of flexible office space design. So flexibility is super important because everybody, I believe, thinks that this industry is going to keep evolving in a much faster pace than it has historically. Which brings us well into our last section, which is real estate, right? And we touched on this a little bit with this discussion around needing to be agile, needing to change. But if we step back for just a second and revisit these headlines, right? All this retail is dead, Twitter speak that we're seeing. makes everyone think that retail real estate is on the decline. And what's fascinating is that it's not necessarily true. When you look at retail rent growth, which is a really great indicator of how retail real estate is doing, retail rent growth has actually been positive and in many cases accelerating since 2014. So you can see here the year-on-year growth in retail rents across the country. The main driver of this, I would argue, is record low levels of new retail construction. This is really, really critical and probably one of the most important data points to understand retail today. So you can see here, which is year by year, the amount of new retail stock that's been built or completed in the market. You can see how it plummeted to about a quarter of what it was producing before the recession versus after. This is down to a lot of factors. One is the cost of construction, of new construction. Two is the availability of land and areas to build successful retail on. And three is general skittishness around retail that's keeping lenders away from the space for new construction and new projects. The opportunity here is as retailers are rethinking their portfolios and their store footprints, they're focusing on a lot of quality over quantity, and I'm sure you're seeing that with a lot of your retail clients. At the same time, if they're all rushing towards the same locations and types of retail spaces, there are no new locations and retail spaces in those areas to welcome that demand. So what's happening is it's creating a real demand drive rise in the same location. So rent is growing there, availability is going down. And the other thing that this is driving is a lot of investment on the part of landlords and retailers reinvesting in their existing locations, in their existing assets. Because when there's no new retail construction, there's a sort of opportunity to refresh because you don't face competition from new shiny objects down the street. So in order to compete and stay relevant, they're having to reinvest and redefine in a lot of cases. So you're going to see a lot of redevelopment as opposed to new development going on.
And I think those are some of the headlines we're seeing is that CapEx expenditures is into fleets, not into expanding fleets. And for this group, for this audience, you know, all these negative headlines we're seeing, we really need to be seeking out these other headlines to see what a group like Target is doing or a group like Macy's, or who are the groups that are rethinking their brick and mortar location the way that Melina has described. Perhaps that store becomes part of their distribution network for the thousands of doorsteps, final miles for delivery. Those are all CapEx projects, and it's perhaps not the headline that we would have seen before that would have rushed us all out to do some business development. It's finding the work or finding the opportunities, but in a different source.
Absolutely. I think Target's a fantastic example of that. You're investing a lot of money into existing stores as opposed to new stores, and it's actually paid off. You know, they had their earnings call about a week or two ago, and they reported record sort of profit and same-store sales increases. And that's really rare for the industry to see online increases and profit increases at the same time, and they're attributing a lot of that to their efforts at in-store refresh, grocery in some parts, but they've also been really driving order online, pick up in store, and then redesigning the stores to make it efficient and convenient for consumers to pick up their online purchases because it's better to get them in the store. I think McDonald's is another great example of a retailer, F&B obviously, that's reinvested a lot in their store formats and in their design in an effort to stay relevant in a really competitive space. And I think what they're doing is really interesting as well.
The buzzword that we're hearing with many retailers now is store of the future, and it could be in furniture rental, it could be in value price cosmetics. If they didn't need to reinvest in their stores, many retailers choose not to, and now is the time that they do. And you know, from my standpoint, when I hear a retailer say, our new prototype, our new store of the future, that translates to me in high volume, multi-market remodel program.
Absolutely. Banking as well. I know we mentioned Capital One, but almost every bank I've spoken to, every major bank in the country has a sort of bank of the future concept that they're playing with. really, really important for these big retailers. And so really quickly on real estate before we wrap up is, it's important to note that even though rent growth is strong and you've got the boost coming from low new retail construction, the performance and prospects really do vary quite a bit by retail asset type. So here I've got a quick slide on the availability rate, so essentially vacancy by different shopping center types. And the takeaway here is that total retail looks fine, just as it did with the rent growth, but we are seeing some challenges in certain segments like the mall space, which you see in green below, and power centers. Now, the interesting thing here is that those two segments, although there are definitely growth areas and then areas where they're not doing so well, those are the two segments of the marketplace that got hit the most by store closures. So if you look back since 2016, 2017, most of those big retailers that went bankrupt or closed stores were located in power centers or lifestyle and mall centers. And if you look just at 2019 alone, where the store closures are versus where the store openings are, on the left you have the closures, and you can see a lot of these brands are mall brands, right? Gap, Chico's, Charming Charlie, Payless, Gymboree. If you look at who's opening stores, Dollar General, Dollar Tree, Peloton, Ulta Beauty, Hobby Lobby, a lot of these are in that low price discount space I talked about before. And a lot of these are actually big box. So in the power center space, you're seeing a re-merchandising going on towards off-price and discount.
Could you go back one slide to your graph there? So yes, that one. So can you make a generalization? There's one category I don't see on there, which is central business district or high street. Are you able to make a generalization or a conclusion, or is that too market specific to draw a conclusion applicable to this chart?
Sure, yeah, so high street retail, urban retail in general is doing well. The U.S. is urbanizing, so even if we're moving towards residential, towards the suburbs, we're still very much anchored to the city for work, for play. So urban traffic is great. What's happening with urban retail is rents definitely going up, but you have in a lot of cities what I call a splintering of retail districts. So if you take New York as an example, or even DC, 10 years ago, you'd have one main area where every retailer wanted to be. And that would drive rents up and drive vacancy down. Today, because cities have developed so much, and there was a move after the recession of people moving into the downtowns, what you've had is a growth of multiple retail districts, right? So in New York, you have luxury retailers that now not only look at Fifth Avenue, but they're looking at Soho and Chelsea, or Brooklyn in some cases. In DC, they're not just looking at Georgetown anymore, they're looking at City Center downtown, which is a luxury, new luxury development. They're looking at Shaw and DuPont Circle. So that's created more competition and more opportunities for retailers across the city. But urban retail very much alive and well. And then you see some luxury retail destinations like Fifth Avenue with a lot of vacancies just because retailers are looking to disperse across the city.
Great, thanks.
Sure. And the other area I want to hit really quickly is the growth of non-traditional retail categories. And I think this is really, really important for your industry group, because what we see and talk about a lot in the headlines is traditional retail, right? Okay, we've had a lot of bankruptcies, we've had a lot of closures of these traditional retailers, and the big question is, are those retailers that are opening enough to cover the loss of the retailers that are closing? And one of my points is that it doesn't matter as much because there are all these other non-traditional retail industries that are very significantly looking at retail space. So if you look at two things like fitness, which I have here with Orange Theory, or medical, and this is an example of a group called One Medical, healthcare chain, these are not considered retail. These are not considered retailers in a lot of traditional retail headlines and data sets, yet they're coming in full force for retail space. So fitness and medical in particular are two areas of growth in consumer spending and growth in their respective industries that are driving absorption in retail space, right? But what's interesting with them is they, a lot of times, as a bit of background, they're prohibited in a lot of shopping centers. So old clauses in shopping centers will often say you can't have fitness and you can't have medical. And now that's changing because they're traffic drivers, they're great tenants, a lot of times can come with credit, and they're driving people to a center, and they have good co-tenancy and synergy with things like grocery and drugstores and other sorts of convenience retail. They do demand quite a bit of money around CapEx spending for fit-outs. They'll have different parking requirements. But in a lot of cases, landlords are willing to work with that because of the traffic it's going to drive and because there may not be traditional retail demand in that area anymore. So this is a significant area of growth I see in the industry. Now, I have a couple slides here that I'm going to zoom through really quickly on retail asset types, and I'll just talk on a couple since we're running short on time. But with grocery anchored strip, there's a lot of talk here because there's fear that grocery is going online. Now, grocery luckily has been relatively shielded from e-commerce growth. About less than 3% of groceries are being bought online. That's going to grow, but the important thing here for grocers is the grocery store is still going to remain a really, really important node for grocers, both for delivery and for pickup. So I think what you're going to see with grocers is a lot of investment in prepping their stores for e-commerce, and that will be curbside pickup. That will be easy pickup within the front of the store. And you might also see shifting in the distribution of store space within each store to allow more space for logistics and distribution and warehousing and slightly less for the consumer shopping area. So I would stay tuned for that, and we're going to see demand for that grow. The other area where you'll see a lot of CapEx spending and possibly re-tenanting is in unanchored strip, which is sometimes called community centers, because these strip centers anecdotally are not subject to a lot of the clauses I mentioned before, saying you can't have medical, you can't have fitness, because there's no strong anchor there that demands those clauses. So there's a little bit more flexibility with unanchored strip, and I think you'll see a lot of re-tenanting and re-merchandising of these spaces to adapt to the demand, consumer demand of today. And then finally, on power centers and mixed use. Power centers I mentioned before, I think what you're going to see there is less demolition and reformatting and more just re-tenanting different kinds of merchants and a lot of curbside pickup. So prepare for that from a CapEx standpoint. And then I just wanted to touch on mixed use because there's definitely what I call the mixed useification of retail and real estate, where the big new trend that's been going on for quite some time now is this idea that having live, work, play environments benefits all three, whether it's office or housing or retail. But this idea that especially in urban and densely packed suburban markets, having the presence of all three feeds in a 2 + 2 = 5 scenario. So there's going to be a lot of redevelopment of existing buildings into mixed use. So I want to touch really quickly on the mall before we close because I have a little soft spot in my heart for the mall. And the main challenge with the mall today is not that people hate malls. It's what I call a merchandise challenge. If you look at the mall, about 50% of the GLA of these malls is department stores, and about 60% of the inline space, so the remaining stores, are apparel. And if you think back to the early slides I showed, those are two of the slowest growing categories, and they're also among the highest for e-commerce penetration and growth. So what you have is an entire asset type that is dependent on categories that are in decline. So we're going to see, and we've already seen it, but we're going to continue to see a lot of capital spending, capital expenditure on reformatting malls, turning them into open-air centers, and re-merchandising them towards things like food and beverage and entertainment, which are the higher growth categories. Now I'm going to skip over the next in the interest of time. And what I want to do is talk through what the opportunity is that I talked through a bit on these slides. So as I see it, landlords are investing really heavily in re-merchandising and redesigning their shopping centers for all the reasons I talked about at the start around how consumer spending is shifting. It's moving away from things like apparel and towards things like restaurants and health and beauty and fitness. And there's going to be a lot of spending to adapt existing space to those uses. two is that retailers and landlords at the same time are really competing on in-store experience. So what we see in urban high streets of these flagship and concept stores, we won't necessarily see the exact same thing in the suburbs, but I do think that the bulk of experimentation will happen in the cities and then translate out to a lot of these suburban chains. So think about retailers investing a lot in the store experience and trying to be unique and distinct to drive traffic to the store, because that's where the profit margin is greatest. And then finally, as we talked about before with Brad, there's a fundamental need for agility and flexibility for both landlords and retailers. So they're really thinking about that and how do you, adapt it today while preparing for the future. So with that, I'll pass it over to any questions you might have.
So, couple questions. So, and it's nice to end with not only the trends, but some bright spots. We're certainly seeing the landlords investing heavily in redevelopment, and that is a shining spot out in the industry. Talk about the move to the suburbs. I'm going to tie it back to your diagram of the mall there. The move back to the suburbs, when Millennial Ben moves back to the suburbs, what do you envision that mall footprint as it transforms? What does it turn into? What types of uses, what types of retailers, what would you expect that it looks like?
That's a great question. I'll pop up to the slide that I didn't touch on, which is here, which is the mall. Now, every mall has to be treated a little bit differently because it's so dependent on the market and the demographics and what that specific community and market needs. But what we're seeing is a mix of malls that are in areas with healthy retail demand and healthy consumer demand. It may just be a question of re-merchandising, maybe towards some of those off-price and discount categories, adding more food and beverage. That's sort of redevelopment light, right? It's just re-merchandising. Mm-hmm. Mm-hmm. The next kind of tier of malls where really retail demand, consumer demand has shifted so fundamentally, or there are too many malls, that you really need to fundamentally redevelop a mall. And so we're seeing, in cases where there's demand for it, mixed usification, as I mentioned. So you may take a mall and convert a lot of the space and turn it into multi-level housing, hotel, office, and create a sort of live, work, play, mixed-use environment. So you have significantly fewer retail tenants and space, but more kind of multi-use space. And then a third category we're seeing is conversion into non-retail. So you've got examples all over the country of malls that have been converted to industrial warehouses. You have malls that have been converted to health complexes, medical facilities, schools. So that is a sort of rarer breed, but we are seeing it happen. But a bulk of malls are going to most likely, in that B, C, D mall range, be sort of de-retailed in some ways and diversified in its tenant base.
So I'm going to end with one final question, and it's near and dear to all of the RCA members on this board. Because you're in research, all of us want to ask researchers, can you give us some insight into labor costs? It's so paramount to our industry, finding labor, but also the costs that go into our projects. Can you speak to that for a second, and then we can wrap up?
Oh, absolutely. And labor costs are huge for retailers in a lot of ways, right? And I'll take the example of food and beverage. Right, so if you look at a lot of these fast food chains or fast casual chains, labor costs have been a real challenge for them as they try and expand, as they move into cities where they know there's a consumer spending, but then costs for labor costs go up significantly, right? So how do you balance the need to expand and then the kind of rising costs with that? And one of the things that we're seeing in food and beverage is real investment in technology, data, and automation as a means to sort of mitigate the growth in labor costs. So what we're seeing in that space is a lot of automated ordering, mobile pickup, kiosks. McDonald's did a big push for this of ordering from kiosks rather than people. And we're seeing that across a lot of categories where they can. So there's a lot of investment in trying to streamline operations, both on the front end and the back end, and using automation and data to try and predict what consumer demand will be, where it will be, what's needed in warehouses for distribution purposes. So in my view, a lot of the labor cost growth is being mitigated by or combated with investment in technology and automation that will hopefully streamline and lower the amount of labor that's needed to execute?
Well, I'm gonna move us to closing up here. Melina, first of all, let me thank you, because the insight that you provide is respected, certainly not only at CBRE, but it's respected industry-wide. Melina is most certainly one of the brightest people that I've had the opportunity to work with, and I can't thank you enough for sharing these thoughts and your slides with the RCA and the RCA Advisory Board. For the members that are listening and participating, thank you for joining us for this first installation. We will be posting these in repository format with the RCA website that they can be referenced in the future. So thank you for joining, and have a great day. Pretty soon we'll send an email notification about the next speaker in our series. So again, everybody, thank you for participating. Have a great day.
Thanks, Brad.
Thank you, Melina.